Thank you for joining us for the mid-quarter update. We have a lot to cover, so let's dive in. The market is sending mixed signals. While global markets are marginally higher, U.S. stocks struggled in February, while international markets posted gains, signaling a potential shift in investor preferences. International stocks are benefiting from lower valuations, stronger economic resilience in Europe, and growth in key sectors like AI and technology in Asia. Now, for the year, markets are higher, except for small companies, where there's real concern over interest rates. Bonds posted modest gains, reflecting a stable rate environment, while commodities tell a nuanced story. Copper's surge hints at rising industrial demand, while oil and Bitcoin's declines suggest cooling risk appetites. This rotation highlights shifting investor priorities in a complex market. Earnings season remains steady, with most companies meeting or beating expectations. The economic environment has become more predictable, reducing volatility in earnings surprises and in misses. A key reason is that weekly economic indicators suggest continued economic expansion, with the Dallas Fed's economic index holding steady at positive levels. Yet economic policy uncertainty has spiked, driven by concerns over trade policies and immigration policies. Historically, when uncertainty is high, investors tend to favor defensive sectors with stable demand and recurring revenues. More cyclical sectors like consumer discretionary and industrials can struggle as businesses and consumers pull back on spending until the policy outlook is clearer. And so far this year, that's what we've seen play out. Defensive sectors like healthcare, consumer staples, utilities have been the standout performers, each up over 6%. Now, these sectors have steady recurring revenues, making them more resilient when economic uncertainty rises. Now, more economically sensitive areas like consumer discretionary and technology have struggled. And this shift highlights the market's current preference for stability over growth. And we may be seeing the early signs of a different shift. International stocks, especially developed markets, have outperformed the S&P 500 and NASDAQ so far this year by nearly 6 to 7 percentage points. Now, this started around the inauguration. While tariffs and trade tensions could be a factor, this trend also reflects expectations of rising growth rates and lower valuations abroad. So the key question is, are we witnessing a changing of the guard in leadership? Large cap growth and the Magnificent Seven stocks continue to trade at elevated forward price earnings multiples, with valuations near their historical peaks. The S&P 500, NASDAQ, and AI-driven sectors remain expensive compared to their historical levels. And we can see the contrast with international stocks, which are trading at lower valuations and much more in line with their historical levels. Valuations continue to favor international markets over U.S. stocks. While having comparable growth rates, the expected return for global equities is significantly higher, and that's been driven by free cash flow yields and less valuation risk. And you can see that valuation disparity as U.S. markets are trading at a premium. Global diversification looks increasingly attractive. Changing gears, let's talk about inflation. Supercore inflation remains stubbornly high, particularly in transportation and medical costs. Now, this suggests that the Fed's fight against inflation is far from over. Now, we're monitoring this as it plays out in terms of how we think about duration in fixed income. And markets are not pricing in the first Fed rate cut until September 2025, with only a modest decline of 40 basis points over the next year. And there's a 50-50 chance of another cut before February 2026, keeping policy rates elevated for longer. Now, the implication is to expect higher interest rates for longer, which means it's unlikely that we'll see expanding valuation multiples in the stock market. The portfolio actions that we're taking. Given market conditions, we're focusing on assets with strong cash flow growth and reasonable valuations, like energy infrastructure. We're also increasing exposure to floating rate debt, and that's a hedge in case inflation reaccelerates and moves higher. With that, I'm Simeon Wallis, Aprio's Chief Investment Officer. Please reach out to your Aprio Wealth Advisor or to me if you'd like to discuss further. We're always here to help.